Oh, there's so many yummy vegetarian options out there. You could try like lentil soup, veggie burgers, tofu stir fry. The possibilities are endless. So, you're running a business, or maybe you have some investments here in Canada. Chances are you've had to borrow money at some point. But here's the big question, right? When is the interest you're paying on that loan actually deductible on your taxes? When does the CRA, the Canada Revenue Agency, actually say, yep, that counts? Well, that's exactly what we're going to get into so you can make every single one of those interest dollars work for you. Here's our game plan. First, we're going to nail down what I call the golden rule. This is the one principle that everything else is built on. Then we're going to put on our detective hats and learn how to trace your loan, which is crucial. After that, we'll jump into some real-world business examples, untangle some of the more complex rules around property, and we'll wrap up with a really powerful strategic choice you might not even know you have. Okay, let's get right into section 1. And you're going to want to pay close attention here because, seriously, everything we talk about today comes back to this one fundamental idea. If you get this, you are way ahead of the curve. So there it is, the golden rule. In a nutshell, it says you can generally deduct the interest you pay on a loan as long as you use that borrowed money to try and earn income from a business or property. The keywords there are reasonable rate and to earn income. This is the foundation. It's the very first question the CRA will ask. What was the purpose of this loan? So let's make this super simple. It all boils down to why you took out the loan. You borrow money to buy a new piece of equipment for your profitable company? That interest is deductible. You get a loan to buy a rental property that you're going to lease out? That's deductible too. But what if you take out a loan for a vacation? Well, that's a personal expense, so the interest is a no-go. And it's the same for, say, an interest-free loan from a family member. If there's no interest being charged, then of course there's nothing to deduct. Makes sense, right? And here is a super important detail you have to get right. When the CRA talks about income, they mean something very specific. You can't just borrow money to buy some stock, hope it goes up in value, and call it a day. That increase in value, that's a capital gain. To be able to deduct the interest, the loan has to be used to generate direct, ongoing income. We're talking about dividends from that stock, monthly rent checks from a building, or interest payments from a bond. All right, so now we know the golden rule, but how do you prove you're actually following it? Well, the answer is a concept called tracing. You really have to think of yourself as a financial detective. You need to be able to show the clear path the money took, from the moment it left the lender to the exact income-earning thing you used it for. And guess what? The burden of proof is 100% on you. It's all about having a crystal clear paper trail. Step 1, you get the loan. Step 2, you immediately, and I mean directly, use that money for something that qualifies. Step 3, you document everything. Bank statements, contracts, receipts, you name it. The cleaner that connection is, the more solid your claim is going to be when it's time to deduct that interest. Now, this is a classic mistake, so listen up. Let's say you take out a business loan and you just drop it into your main checking account, the same one you use for groceries, gas, movie tickets, you name it. You've just created a massive headache for yourself. The CRA says it's now your job to prove that the eligible business expenses you paid out of that account were more than the loan amount you put in. The easy fix? Just open a separate bank account for the loan money. Seriously, it's clean, it's simple, and it will save you a world of pain down the road. Okay, theory is great, but let's talk about the real world. In this next section, we're going to take that golden rule and our new tracing skills and apply them to 5 common situations that business owners face all the time. This is where the rubber really meets the road. We're going to tackle some big questions, like can you borrow to pay out dividends? Or what about lending money to key staff members? Then we'll get into some more complex stuff, like contributing capital, what happens when you have to make good on a loan guarantee, and even how leveraged buyouts work. Okay, first up is a real classic. Imagine your company is doing well, but a lot of your cash is tied up in day-to-day operations. You still want to give your shareholders a dividend, so you decide to take out a loan just to cover that payment. The question is, can you deduct the interest on that loan? What do you think? And the answer, which might surprise some people, is a clear yes, you can. The series logic is that paying dividends is a normal part of business. By borrowing money to do that, you're basically replacing the capital that your business was using to earn income, so they see it as a legitimate deductible expense. All right, scenario number 2. Let's say your company borrows some money at, say, 5% interest. Then you turn around and you lend that same money to a star employee to help them with a down payment on a house, maybe as an incentive to keep them around. Can your company deduct the interest it's paying on that original loan? Again, the answer is yes, but there's a really important condition. The loan has to be considered a form of compensation, part of their pay package. The CRA views this as an investment in that employee. The idea is that their continued hard work and dedication will generate more than enough income for the business to make it worthwhile. It's an indirect connection back to the golden rule, but it absolutely counts. Okay, let's slow down and walk through this table, because these situations are a little more complex. First up, contributing capital. So you borrow money to invest in, say, a subsidiary company. The interest is only deductible if you can prove that your investment is meant to produce income for you, specifically that you have a reasonable expectation of getting dividends back. Next, honoring a guarantee. This is almost always a no. If you co-sign a loan for someone else, they default and you have to borrow money to pay it off. You generally can't deduct that interest. Why? Because you didn't use the borrowed funds to generate your own income. And finally, leveraged buyouts. This one's a definite yes. When you borrow money to buy the common shares of another company, the interest is deductible. It's a fundamental part of how many business acquisitions get done. Let's shift gears now into our fourth section. We're going to get into some of the more advanced and, frankly, sometimes confusing rules that come up when you're dealing with property and land. This one is so important if you're a developer or you invest in land. If you borrow money to buy a vacant lot that's just sitting there, not being used in your business, not generating any rent, you can't just write off all the interest and property taxes against your other income. Your deduction is actually capped by whatever net income that specific piece of land generates. And for vacant land, that number is usually zero. Now for a really interesting and tough situation. Let's say you bought a rental property with a big mortgage. A few years go by, the market tanks, and you have to sell it at a loss. Even worse, the money you get from the sale isn't even enough to pay off the loan. You still owe the bank. Can you keep deducting the interest on that leftover debt? So the official language from the CRA on this is, well, it's a little dense. They say the taxpayer is deemed to continue using the borrowed money for an income purpose, even though the property itself is long gone. It's a bit of legal wizardry, but it's there for a very good reason. So let's cut through all that official jargon. The simple answer is yes. Yes, you can. As long as you can prove that you used every single dollar from the sale of the property to pay down that original loan, the CRA allows you to continue deducting the interest on the remaining debt. This is a hugely important rule for any property investor to know. And that brings us to our final section. Now, this isn't another rule you have to follow. This is about a powerful strategic choice that you can make to really optimize your tax situation. It's all about timing your deductions to get the biggest bang for your buck. Just picture this for a second. You're launching a new business. You've borrowed a ton of money to buy a building or some expensive machinery. So in your first year, you've got this huge interest expense. But you're a startup, so you have very little income. That big, juicy interest deduction, it's pretty much useless. It's going to be completely wasted. So what do? You can make a choice. It's called an election to capitalize your interest. What does that mean? Well, instead of claiming it as an expense right now, you actually add that interest cost to the value of the property you bought. So if you had $10,000 in interest costs in a year where you had no income, you could add that 10 grand to the cost of your building. Then you get to deduct that cost slowly over many years as part of your capital cost allowance claim. It's a fantastic strategy to push that deduction into your profitable future years when you can actually use it to lower your tax bill. And really, that's what this all comes down to. Knowing these rules isn't just about avoiding trouble with the CRA. It's about being smart and strategic. From meticulously tracing your funds to understanding these very specific scenarios to making a savvy choice to capitalize your interest, you have some really powerful tools you can use. So the question I want to leave you with is this. Are you actively managing your debt to make sure your interest deduction strategy is truly working as hard for you as it possibly could be?